We're half an hour away from the market opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show live at the HKMA Global Financial Leaders Investment Summit. I'm Yvonne Man with David Ingles.
Yep, we're here at the fourth edition of the HKMA Leaders Summit, which our host earlier on, Eddie Yu, of course, told us but was supposed to be a one-off 4 years ago. But here we are, of course, in the global pull. You really feel it with all the VIPs across the world coming into the city, attending this event. In fact, just right now, right inside the ballroom where we are right now is Lifeng giving the opening speech. Have a look.
Development. And we will follow the train of globalization and deepen the institutional opening up and expand high-level open up to the world. We will orderly expand the trade and investment liberalization and facilitation and foster a first-class business environment that's market-oriented and rule of law-based. And together with all parties, we will work to meet the difficulties and challenges that global trade faces, jointly safeguard a healthy and stable international economic order, ensure the stability of global industry and supply chain, promote global economic growth, and bring benefits to people of all countries. Ladies and gentlemen, dear friends, Hong Kong's Global Financial Leader Investments has successfully held 3 terms, serving as a very important platform for deepening international financial exchanges and promoting global financial cooperation. It's also a very good opportunity for international financial institutions to understand Hong Kong's developments, and it is also a very important window for Chinese mainland institutions, and it is also a very good opportunity to enhance dialogue. The guests present here today are all experts in economy and finance. I hope that you can all make full use of this platform and share insights, deepen communication, and exchange on issues of common concern, and constantly increase our consensus and seek win-win cooperation. I hope we can have your continuous support for Hong Kong's development and actively participate in China's reform and modernization. Amidst these uncertainties, we hope that we can inject more stabilities and positive energy into the global economy and financial system. In closing, I would like to wish this summit great success.
Thank you, Mr. He, for the keynote. Over the past 3 investment summits, many participants have told us that this event serves as an important window into the latest economic and financial.
All right. You just heard there from Lifeng speaking in a video address, of course, to the crowd here in Hong Kong. And what we heard was really the prospects for Hong Kong, according to the Vice Premier, remain bright, right? That bridge and link between Hong Kong and China very much is still what keeps the whole Hong Kong story alive and really connecting China to the world, he says, too. And, we talk about the sentiment just coming off of, what we saw in Busan.
Yeah.
Of course, we come to a trade truce between U.S. and China. And then you have this sort of Hong Kong event, where equity markets are still booming. You talk about the IPO market is still strong. And it really gets a sense of how things are very different on the ground this time around versus maybe 4 years ago when we were here together anchoring the show for the first time at this event, Dave.
Yeah, the 2022 version, Eddie, you told us. Post-COVID was supposed to be the reopening and the comeback of Hong Kong following, of course, years during the pandemic. And he mentioned it was supposed to be actually be a one-off event. And then it just sort of snowballed from there, and here we are. And it did take a while for the stars to align, right? So I think we were speaking with Eddie earlier on. We have a bull market in the equity market with massive fundraising, and he, in fact, even said it's not just in equity markets.
Yeah.
We've seen a lot of activity in the bond markets, and he also talked about how Hong Kong is, as we were just pointing out there, the gateway into China. And we heard from Lifeng, and in fact, Eddie Yu, in a couple of minutes, will be starting this keynote speech inside with a lot of Chinese regulators talking about the role of Hong Kong in all of this. So it did take a while, but we're here, and how the stars have aligned for really a good set of conditions to have this this event.
Yeah, we heard from David Solomon as well. It's not just the optimism around Hong Kong specifically, but what he's seeing in China, he says, is a bit of a different feeling than maybe 12 months ago. Let's take a listen to what we heard just in the last few hours.
I think the important point for all of us is really just to address the risk, manage the risk. But at the same time, we are seeing loads of different opportunities. You talk about how our capital markets are really getting very vibrant. But it's not just the equities market. It's also the bond markets. If you look at the issuance of dim sum bond, one-time bond, green bonds, it's broken all the records. So I thought the market sentiment here is really vibrant.
There's more appetite for it than there was 12 months ago. I remember actually last November sitting in a dinner in the United States with a group of U.S. investors. And this topic came up, and there were a couple of investors that basically said, we all should be looking to China. And the reason that had evolved that way is if you look last fall, the prices had gotten so cheap, the capital flows had moved so in the other direction that you just knew that things would come more into balance and there'd be a recycling. And we've seen that recycling.
Yep, and this, we're just getting started when it comes to guests, right? We spoke to Schroders, we spoke to Goldman here, and coming up, we have plenty of guests in the next few hours here. First and foremost, of course, we're going to talk a little bit more about the state of play when it comes to private markets, right? Yeah. And we're talking a little bit more with our guests that are coming up.
Yeah, Hamilton Lane, State Street, Mizuho.
So they just completed this deal,
yes,
right?
This is
when it comes to the global custodial business. We'll talk to both the leaders of State Street and Mizuho on that sort of deal. And Jenny Johnson from Franklin Templeton joining us there in the next hour as well.
Yeah, we got pretty much all your asset classes covered. And what's interesting about this, so we've done this for several years. I think this is actually going to be my first time to do a roundtable with two global CEOs.
Yeah.
Of financial institutions.
From in the field live, right?
From the field live. So it's going to be a logistics, gymnastics for you, but I promise we'll try and get them smoothly to you. So yeah, stay tuned, of course. There's lots more coming up from our set here at the Hong Kong Financial Leaders Summit. We will take you straight back inside now where you have Eddie Yu. He's moderating this panel with Chinese financial regulators. Let's have a look.
Relaxed monetary policies and measures to support stable growth of our economy. We ensure reasonable growth of our fiscal policy and also provided long-term liquidity. And we have offered very good support to the operations of medium-term loans, and also we are providing support to the physical economy in terms of credit demand being met. And we are launching a number of policies to lower the financing cost for institutions and also for other types of loans in our community to address real needs. And we also optimize our credit structure. We have set up a re-loan mechanism, and we have set up an innovation and technology bond risk-sharing tool at the level of 300 billion RMB so that we can truly support the retirement life of Chinese people and also support the inclusive economy and green economy. We will spare no effort to the execution of such policies. In terms of supporting Hong Kong as a financial center, in recent years, we have been dedicated to such efforts. In January this year, Mr. Pan at the Asian Financial Forum talked about 4 major areas of his work and also all the relevant measures. We will continue to deepen the connectedness between Hong Kong and mainland China. For example, we are going to strengthen the setting up of the offshore renminbi center in Hong Kong, and we have been responding to the aspirations in the market so that we can further promote various levels of connectedness, including Bond Connect. And we have also provided a lot of support to mainland and also overseas investors concerning the buyback of bonds, so that this will become a very well-recognized collateral in Hong Kong. we will enhance the efficiency and also the value of daily transactions. And more than 1,100 overseas organizations have already entered the bond market, and the scale of such bonds have reached 3.8 trillion renminbi. By the end of July, we have reached a huge amount of investment cross-boundary. And we have also done a lot in terms of the gold market. And we have already commissioned the operation of the gold reserve in Shanghai stock market. In February this year, we have supported the Hong Kong MA to launch a huge-scale liquidity fund, and we have expanded the use of funds in October so that we can ensure low financing cost in terms of renminbi for many commercial banks. We have already reached a very high level of transaction on this front, and together with the relevant government departments, we have set up in Hong Kong offshore renminbi debt and other product offerings. For the first 9 months in Hong Kong, we have launched central bank debt, which is at the level of 30 billion yuan more compared to last year. So we have launched a number of connectedness measures to promote better connection of services so that we can better serve the 9 cities inside the Greater Bay Area. And we have attracted more people to set up bank accounts and provided a lot of convenience for residents in Hong Kong and Macau to live and also receive education and work in mainland China. SIF has been set up, and we have reached 113 organizations facilitating international trade and investment across the border. And we have also set up e-payment platforms to promote the Greater Bay Area in terms of safe and convenient cross-border payment and transactions. We have been working very closely with many institutions. For example, we have covered many enterprises in Shenzhen. We have offered bank financing to many institutions across the border. We are looking at unprecedented uncertainties and fluctuations around the world. This year, we are talking about tracking forward into unknown and fluctuating terrain. I trust that Hong Kong will continue to play its important role, not just as a very attractive financial center, but also we are going to work together with government departments to render our strongest support to Hong Kong so that we can make contributions to the Greater Bay Area, so that we can have high-quality development, we can facilitate cross-border activities and investments, and improve the overall investment environment. I understand that you are all financial leaders from around the world. We look forward to deepened interactions and exchanges with all of you so that we can all create a better future for Hong Kong as a financial center and create great premium to China as well. I wish this forum or the summit a great success. Thank you, Mr. Lu. Now, let's invite Mr. Zhou Liang to talk about how we can further promote the development of our financial sector and foster Hong Kong's position as an international financial market. Distinguished Chief Secretary Lee, Mr. Xu, Mr. Paul Chan, Mr. Eddie Yuan, distinguished guests, ladies and gentlemen, it is very honored for me to attend the 4th Global Financial Leaders Investment Summit. Mr. Xi Jinping attached great importance to the long-term stability and prosperity of Hong Kong and has made a series of important instructions. And Mr. He Lifeng has already made a speech through the video, and we will continue to implement the instructions accordingly. As we know that the 4th plenary session of the 20th CBC meeting has already summarized the achievement of our country, which includes the important part of the achievements in the Chinese mainland and the financial system here in Hong Kong. I would like to summarize it in 4 aspects. The first one is the high quality development of the the financial industry. As we know that the banking and insurance total asset has exceeded more than 500 million, and as the world's first biggest banking market and the second insurance market, we have seen great performance. The trustees and insurance asset management companies are managing more than 10 billion. And there are more than 143 of them are the Hong Kong subsidiaries. And we have seen great performance for different indicators for the foreign banks in China. And secondly, we have seen great improvement of the service level. In the past 5 years, we have seen funding of more than 1.3 million provided by the banks. We have seen improvement for the inclusive loans. And we have seen more than trillion yuan of investments that goes into science and technology. And insurance as the buffer for risk, we have seen a claim of more than 9 trillion. And third one is about the stable operations of the financial system. The major indicators of the finance are still very healthy. The non-performing loans for banks is around 1.47%. The profitability of insurance companies have greatly enhanced, and the provisions for risk and capital has exceeded more than 5 billion. And we have seen also the stabilization of our property market, and we have seen great solutions for the local debts. And the fourth one is the continuous consolidation of the IFC positioning of Hong Kong. Hong Kong has banking industries from more than 40 countries and regions. And we have seen great penetrations and coverage of insurance. And from the first 10 months of this year, the IPO scale in Hong Kong is ranked #1. And at the same time, Hong Kong is now undertaking more than 75% of the offshore RMB settlement and payment business. And connectivity schemes, including the Shanghai, Shenzhen, Hong Kong Bond Connect, Wealth Management Connect, and other schemes have been greatly integrated into the national development. And we can see that the fourth plenary session of the 20th CPC meeting has already confirmed the 15th five-year plan for the country, which suggests that we need to build the country into a financial powerhouse, and we need to focus on science and green finance, inclusive finance, pension finance, digital finance, etc. We need to make sure that the financial institutions can focus on their specialty and complete the overall governance framework. It is also suggested that Hong Kong and Macau should play its role as an important connector of the world and the Chinese mainland. And Hong Kong's position as an international financial center, shipping center, trade centers should be further enhanced. And the country support Hong Kong to build it into an international science and technology hub. All these targets and requirements have created new opportunities for Hong Kong. As we know, for many years, Hong Kong has been number one among the international financial centers. In the latest ranking, with Hong Kong's achievements in capital funding, mechanism, business environment, financial talents, and other advantage, has become Asia's number one and global number three financial center. And with the 15th five-year plan, Belt and Road Initiative, and also the Greater Bay Area's policies, the financial cooperations between the Chinese mainland and Hong Kong will embrace greater opportunities and space. For our next step, we will continue to deepen our financial cooperation between Chinese mainland and Hong Kong, and to make sure that Hong Kong can be fully integrated into the national development, and to continue to enhance Hong Kong as an international financial center. First, we need to expand the opening of international finance. We need to benchmark with the international standards and explore in a greater scale and greater scope for the finance openness. And with CEPA framework, we respond actively the demands of the finance industries in Hong Kong and Macau, and continue to open up to the Chinese mainland. And we support the Hong Kong institutions and organizations to come to Chinese mainland to build up a vibrant cooperation and partnership. And we'll continue to deepen the interconnectivity with Hong Kong and the Chinese mainland. Hong Kong as the super connector will continue to play a very important role in terms of insurance. The Chinese insurance companies would be allowed to issue insurance-linked bonds in the Hong Kong markets. And we will also continue to provide more facilitated financial services in the Greater Bay Area. Hong Kong has great advantages in international trade, shipping, logistics, and finance services. There are many cooperation modes that we can explore in the Greater Bay Area. We support the banking and insurance institutes to go global, to help the Chinese companies to reach a broader market. Hong Kong has advantage in the finance, law, insurance, and other professional services. It is a very important support and platform for Chinese companies to go global. And thirdly, we need to focus on the 5 aspects for finance development. We need to strengthen technology, green, inclusive, digital, and pension finance corporations. Hong Kong has an advantage in science and technology, innovation, and IP protection. And it serves as a very good window for strengthening digital currency and electronic payment. We support the Hong Kong institutions to deeply participate in the science and finance practices and digital transformation in China. And we also promote the pension finance in Chinese mainland. And we should enable the green and low carbon transformation and provide China's example and experience to the world. We also participate into international finance governance and regulations actively. We need to effectively balance the risk and development, and we will further complete the cooperation mechanism and policy framework between the Chinese mainland and Hong Kong regulators to promote the high quality of the finance industry. We will actively respond to external risks and strengthen the communications in regulation, and financial safety and stability will be safely guarded. For the uncertainties, we will continue to focus on our own business, and with one country, two systems, Hong Kong will convert the national strategies into new impetus for its own development, while servicing the country's financial development. Hong Kong will continue to write its new chapter as a strong international financial center. I wish this summit every success. In closing, thank you. And I believe that the opening up of the SFC is of great interest to you. And now let's welcome Deputy Director Mr. Lee to share with us his remarks. Distinguished Mr. John Lee, Mr. Xu Qifang, Mr. Zhou Ji, Mr. Paul Chen, Mr. Eddie Yue, Mr. Yang Fengyu, distinguished guests, ladies and gentlemen, good morning. I'm very happy to be here to attend the fourth Global Financial Leader Investment Summit. On behalf of CSRC, I would like to send my congratulations to the summit. We are now situated in an unprecedented time, and we are seeing a lot of uncertainties and turbulence for the global economic order and the financial system. This summit themed tracking through shifting terrains is very timely. Mr. He Lifeng has already made a very important speech about how we can accurately master the trend of the financial industry globally. And he has also talked about the strategic deployment of financial measures and how to promote an elevated development of the capital market here in Hong Kong. We will continue to implement the important instructions. China's capital markets was spawned amidst reforms and continued to open up to the world. And no matter what the international situation would be, China will continue to remain open for its capital markets, and will respond to the external uncertainties with a coordinated manner. In the 14th five-year plan period, the CSRC continue to implement the deployment and policies of the State Council and the central government, and it is always market-oriented and rule-based. For the market access and rules benchmarking, we have launched a series of very iconic open measures with great achievement. Since 5 years ago, we have opened up the market assets. We have canceled the bonds, securities, and futures foreign holding percentage. And we have applied equitable treatment for foreign institutions in this regard. And we support the investment of the foreign financial institutions coming to China to invest. And we have approved 13 foreign securities, futures, and fund companies with great license. And we have seen great growth for the numbers of foreign securities, bonds, futures companies. We have seen great connectivities for the market, and we have completed the regulatory mechanisms for companies to go listed in other countries. There are more than 269 countries going to another country to go public, and we continue to see the expansion of of the connectivity scheme. And we have also provided great convenience for the foreign investors to invest in the Asian market. The holding value is now already reaching 3.4 trillion RMB. Foreign investors have become a great participator for the market. And we have seen greater openness in the products. We have the mutual recognitions of funds and the ETF mechanism. We support Hong Kong to launch the first A-share futures products. And these has catered to the needs of the investors in different risk appetite. And we continue to open up the new products for futures and stock options. And now 24 specific products have already allowed foreign investors to participate. And we are opening up our capital market. Hong Kong, with its expertise and advantage in institutions, capital, and talents, has already become a very important bridge that connects Chinese mainland capital and the world. We are very happy to see that since this year, Hong Kong's capital market has already demonstrated a very good upward trend for CACL, Hengrui, pharmaceutical, and other great enterprises has already gone global through Hong Kong. And competitiveness, influence of Hong Kong as an ISC has continued to be consolidated. This attractiveness continued to grow for foreign investors. And Hong Kong's prosperity means great prosperities for the country. And on the other hand, we have seen the national policies benefiting Hong Kong.
Well, we continue to open up the mainland Chinese capital market, while we continue to develop in a synchronized manner. We can help Hong Kong to foster its position as an international financial market. At the same time, to Chinese economy and high-quality development of mainland enterprises, we are also injecting a lot of energy. Not too long ago, the plenary session has endorsed a number of recommendations, clarifying our next 5-year objective in terms of building the high-quality system. We have already set a very good foundation. We have made proposal in terms of constructing our nation into a strong financial power. We will continue to uphold the spirit of the plenary session. We will control risk and move towards high-quality development. We will deepen the capital market and also complete the mission to continuously open up our market and identify useful measures along the way. We will further enhance cross-boundary facilitation of investment and financing. Last week, actually, we have launched a working plan to optimize investors' system so that we can enhance the efficiency and expand the scope of investment from foreign investors and enrich investment options and provide facilitation and highly efficient measures to further support them, provide more predictability and also clarity to our investors. We'll continue our dialogue so as to expeditiously implement these measures. We will deepen our collaboration with the capital market in Hong Kong. We will enhance efficiency for IPO in Hong Kong. Renminbi stock transaction counters would be included into our framework. We will support the futures market in Hong Kong, enrich the management tools for offshore renminbi initiatives, and help Hong Kong to continuously foster its position as an international financial market. We will create healthy interactions. Thirdly, we will further enhance our regulatory capability and risk aversion capability. We will deepen cross-boundary legal protection and collaboration, including the Hong Kong MA. We will share more information, co-negotiation of policies to prevent risk from crossing the border. At the same time, under the OSCO framework, we will continuously promote the capital markets' fair, just, and inclusive characteristics. Dear guests, dear friends, Chairman Xi has already pointed out, if you work with China, you are working with opportunities. If you trust China, you are believing in your future. Under the 14th Five-Year Plan, we have achieved a growth of 5.5%, and we have provided 35% of stability to the world economy. We have very good pillars of support for the Chinese economy. If you look at our Asia market, they have stabilized and rebounded. This year, major indexes have been improving. Total market cap exceeded 111 trillion renminbi. And our two stock markets, the average daily transaction is about 2 trillion. We welcome more international institutions and long-term capital to come to China to establish your foothold so that we can develop and win together. I have a number of ideas that I would like to share. First of all, it's about investment value. Our policies and initiatives are being implemented so that our overall system continues to be optimized. Our internal tenacity has improved. In the first half, Asia companies' net profit and revenue have grown. For the first 3 quarters, our dividend payout in total reaches 2.1 trillion renminbi. And the fluctuation has eased off. So we should be your preferred destination of investment. The Chinese economy is strong, and it will provide continuously unprecedented investment opportunities to all of you. In terms of our journey on modernization, you should grasp such opportunities to share the premium of our development. In terms of being a contributor, the 14th Five-Year Plan already stipulated that we need to be more inclusive and we need to perform greater functions as a capital market. How do we move with the times? How do we deepen reform measures and innovation so that new businesses, new technologies, new enterprises can receive more inclusive services so as to better serve high-quality growth and development? That is indeed an important topic for all of us. We hope that international organizations can share.
All right, welcome back. Good morning to all of you joining us from the Asia Pacific. Good evening if you're joining us from other parts of the world. Welcome back. You're watching the China Show. You're looking at some live pictures there of the event that's taking place right now here at the Rosewood Hotel down in Hong Kong, in the HKMA Global Financial Leaders Investment Summit, where just outside that room, coming up on your screens, any moment now, is going to be Yvonne and myself. We're right outside, of course, where things are taking place there. In fact, joining us exclusively to talk about everything that's been going on there, everything that's been announced so far, in particular this, I wouldn't say renewed vigor, but just this resurgence again of interest in private markets. Joining us here on set is Hartley Rogers, Executive Co-Chairman at Hamilton Lane. It's very nice to see you and good morning.
Great to see you, David.
Thank you.
To see you.
Thank you for carving out a piece of your time. I know you stepped out from what's going on inside. It's been a fantastic few years for your asset class.
Yes.
Have you had to turn money away at this point? Are you closing the door? Like, how good have things been? How much growth have you seen this year?
Well, I think we've seen a fair amount of growth from some channels. I wouldn't say we've had to turn money away, but we certainly are prudent in how we invest the money. You have to be careful that you're balancing the inflows with investment opportunities that you're seeing across the different things that we do.
I mean, you guys just reached a key milestone, which is $1 trillion in assets here right now. What gives you confidence that this boom in private markets, for example, can continue?
Well, I think, first of all, private markets have been around for a long time, and they've proven themselves over decades as being a great way to invest and a great ownership structure for certain kinds of companies. Not everybody, but for certain companies. And so we believe that the fundamental reasons why private markets work are still there and will continue to work for the foreseeable future, especially as economies grow and develop, as you're seeing here in the Asian region.
Where are you seeing the fresh money coming from? Are you seeing new types of clients? Is it more the sovereign types? Are you seeing family offices, which we hear a lot about here in this part of the world?
Yeah, today it's really coming in a couple of places, mostly from families, wealthy individuals, and then pushing down into democratization in the form of things like defined contribution, pension schemes, saving schemes, and things like that. I think for years, private markets have been the province of sophisticated institutions, endowments and sovereign wealth funds, big pension funds. We see that now changing as they're being made more broadly available to other people. Tokenization is a very important part of that. And that's something we've been talking about here in this conference.
We've also seen some trends, right, where a lot of LP-led sort of deals are being made here in Asia. What do you make of that sort of trend right now?
Well, I think the secondary markets in private equity are very substantial and growing. As you've had an asset class whose net asset value has gone in the last 20 years from something like $500 billion to something like $12 or $13 trillion, you naturally have a lot more ability to shape and customize portfolios, including by vintage, going back in time. And so LP-led secondaries, which I think is, Yvonne, what you're talking a little bit about, is definitely something that people are using more and more.
What about this trend of just reducing exposure to the U.S. dollar? Like, how is that resonating the most this year for you guys?
Well, I think people are wanting to have global portfolios. Private markets forever have been a U.S.-led phenomenon. So going back in time, it's been kind of 70% U.S., 20% Europe, and 10% rest of world has been sort of how the asset classes look for 25 or 30 years. I think as Asia continues to grow, all the different opportunities here, the more sophisticated way that people are acting and investing and thinking, I think people are going to want to be more exposed to the growth opportunities in Asia.
Over in the U.S. where you're based, Hartley, there has been some cracks that are emerging, right? When you take a look at the likes of First Brands and the like, is this something that you think is just a one-off that we're seeing in private credit markets, or do you think there is some sort of systemic risk now?
We do not see a systemic risk today, no. We think that these are one-offs. They're being greatly magnified by the media and by people who have a kind of vested interest, not saying that the media necessarily has a vested interest. But
you're not pointing to us, are you?
I'm not pointing at you. But the people who are talking about it, there are some vested interests in making this feel like it's unstable. If you look at the situations that have been focused on in the press, they're not deals that are sponsored by private equity firms by and large, and this kind of thing does happen. They're not actually that big when you look at the grand scheme of everything in private credit. And in our private credit business, we really have not seen anything like this happen.
Right. I guess that really comes with how wide and broad the spotlight has become in the asset class. I mean, you will be seeing things like this. I want to ask you then, in terms of opportunities in China, we talked about this during the break before we came back live. What are you seeing in China as far as a deal sourcing perspective and also the amount of money that wants to come out of China looking at deals elsewhere?
China is obviously a very important economy, and it's a very important market for any firm that wants to be a global firm in these asset classes. It also, as the economy is recovering, as you've had Hong Kong it being so vibrant and kind of opening up to the world, tremendous stock market performance, lots of IPOs. It's really the gateway, in a way, a gateway in and out of China. And so I think you're seeing a lot more interest in Chinese deals today than you've seen before, as the economy is sort of stabilizing and people are looking at it.
Are there certain sectors or industries where you think that a lot of those deals are concentrated?
Well, I think in private markets, the biggest part of private markets worldwide is buyouts. Okay. And buyouts is sort of a phenomenon of a
we had
more
Starbucks just recently.
Yeah, like Starbucks. Okay. More sophisticated, more mature economy where there's an ownership structure in private markets that could be appropriate for a company. It could be a founder-led company that maybe the founders are getting older. Maybe the children don't want to be in the business and they're deciding they want to professionalize it, bring in outside ownership. That's a wonderful opportunity for private equity. It's also true in corporate carve-outs. If you have companies that have grown and grown, they have different kind of non-core businesses, maybe the management team is thinking, maybe we don't need to be in all these businesses. There's a better ownership structure for some of them. Yeah. And so in any kind of big economy, China, Japan, you're seeing it more in Korea, you certainly saw it in the US and Europe. You have opportunities in driven by both of these phenomena.
How are you looking at exits now, given that we are seeing bull markets in much of this region right now, too?
Well, I think that it's great that the IPO market in Hong Kong has come back. I think that's obviously a critical exit for a lot of private equity markets. I think the U.S. has seen some good IPO activity this year as well. So it feels to us like you're beginning to see the exits come back in to the private equity market. It's been slow for a few years. Really, in a way, the hangover from COVID with the inflation and then the interest rate rises, which kind of dampened activity. I think you're now beginning to see that loosening up.
Hartley, it's great to have you here.
Thank you.
In the region. Hartley Rogers there, Executive Co-Chairman at Hamilton Lane, joining us here, of course, at the HKMA event. Of course, subscribers, you can turn on your terminal for more on the HKMA Global Financial Leaders Investment Summit. T-Live Go is your function on your terminal to check out for the latest updates, commentary, expert analysis, and, of course, some of the interviews that we're bringing to you throughout the day. Dave.
Yeah, speaking of, in the next hour, we'll be speaking with the CEOs of State Street and Mizuho Financial Group. They completed this deal, of course, for State Street to acquire some of Mizuho's business. We'll talk about the rationale of the deal, of course, and what else is in store for both of them individually. And also on your screens, as you can see, Jenny Johnson will be joining us here on set, coming through. Lots more on the way here from the HKMA Summit. Good morning to all of you. You're watching The China Show. Good morning. Welcome back. You're watching The China Show. Let's get to some other news this morning. So Starbucks is selling a majority stake in its China unit to private equity firm Boyu Capital. The price tag there, $4 billion. Now, the coffee chain shares rose in late trade after the announcement. You see that on your screens. Let's bring in our Asia Global Business Managing Editor, Rachel Chang, in our Hong Kong studios for us. Yeah, so Rachel, we've been tracking the ins and outs of the story, and finally we're here. Finally, we have a price tag. How did Boyu emerge as the winner here?
Right, exactly. So we broke the news last week, of course. There were a lot of bidders in this process, and Boyu really emerged as the winner because, first of all, it's a Chinese private equity firm, which means that its connections onshore is going to be that much stronger for Starbucks. We're already seeing that happening. We just broke another piece of news, which is that Boyu is going to be looking for over $1 billion in a leveraged loan from Chinese banks to finance this 60% stake. Boyu also recently closed a really big deal for China's biggest chain of luxury malls, SKP. That means that there's probably going to be a lot of synergies available for Starbucks outlets in those malls, for example. Ultimately, I think it was really that strategy and those Chinese mainland connections that helped Boyu beat out these other global PE firms that were very interested in a stake as well, because that's really what Starbucks has been missing in China.
Yeah, this coming out of time, they've been struggling for years now. Even Luckin has surpassed them in being the largest coffee chain there. So you are seeing these local, domestic, really winners emerge in all this. And this is really kind of the next chapter for Starbucks. What does it mean for them now?
Right, I think that's really the biggest question because for a long time now, people have been pressuring Starbucks to say, look at all, you're getting beat by all these Chinese chains, the Luckin model, quick turnaround, low cost, smaller stores. But, Starbucks has been trying to hold quite firm to its idea that it's a different kind of business, it's premium, it's going to sell lattes at 3 times the price because it has these beautiful stores where people can hang out. So, I think what we're looking to next is whether that kind of model will really survive now that private equity is in charge. China is a very different type of industry, a different type of market where consumers are looking for different things. So, in a couple of years, Starbucks in China might be quite unrecognizable from what we know Starbucks elsewhere to be. Now we have a Chinese PE firm in charge, and we'll probably be looking to grow those margins very quickly.
Rachel, thank you. Our Asia Global Business Managing Editor, Rachel Chang there, joining us from our Hong Kong studios. Let's take you back here at the Rosewood Hotel, and we're taking you live pictures back inside, of course, the Grand Ballroom, and really talking about this macro picture that we're seeing, right? And what you're seeing is the HSBC CEO there, George Heldery, William Ford, Chairman and CEO of General Atlantic, and the UBS Chairman as well, Colm Kelleher, in a panel. Let's listen in.
Trade has become a major driver of foreign direct investment and a major driver for employment. And we've seen that very clearly in ASEAN with Chinese foreign direct investment to build manufacturing capabilities, be it autos in Thailand, be it electronics in Malaysia, be it logistics in Singapore, et cetera, Vietnam, Indonesia have been also big beneficiaries. But also places like India and Mexico have been big beneficiaries of these FDI flows. So they bring with them hard currency, they bring with them employment, they bring with them wealth, they bring with them export capabilities. And they partly benefited from low wages in many of these countries, compared now, for instance, to China. But also, the potential of this growth is massive, because when you look at the FDIs from within Asia, specifically China, we remain at substantial, or multiples lower than the FDIs of some of the more mature economies, such as the US, Germany, the UK, Japan, Korea. So there is massive potential for more will have a different role in global trade. The first thing is the US was the consumer of last resort. Anything manufactured on this planet would find buyers in the US if they couldn't find buyers anywhere else. And that probably will not be the case anymore. Or if it is the case, it will come at a price. And that's a base tariff to access the US consumer. And we just need to be factoring this in the future as part of the US being more self-reliant than it has been historically.
Yeah, thanks, George, for those trends. All you've mentioned actually creates a lot of opportunities for the region, the APEC region as a whole. But apart from opportunities, are there any risks that we need to watch out for in those kind of landscape?
So Arthur, definitely creates lots of opportunity. I just take the opportunity to say that we have, on the 9th of October, announced an offer to invest more than $100 billion Hong Kong dollars in Hong Kong with our offer to take private Hang Seng Bank. So hopefully that talks by itself about the conviction we have in the opportunity we see in the space. But if I talk about the risks, there are a number of risks. Certainly, a big risk is the technology disruption. Adopting it is an opportunity. Missing out on it is going to be a major risk. And it still comes with some of its challenges. Adopting blockchain is a major opportunity. We already rolled out tokenized deposits for our customers in Hong Kong and a number of other jurisdictions. We're participating to the e-Hong Kong dollar. We're participating to Project Ensemble for the interoperability of blockchain. All these opportunities are real, but there is still a lot that's happening on the blockchain away from regulated financial services.
We're very pleased to see that Hong Kong has earnestly implemented the chairman's instructions. With the support of central government, Hong Kong's economy and livelihood have greatly improved. Since this year, We have seen the great economic and social development. We have again proved one country, two systems has strong vitality, that Hong Kong has a solid foundation for long-term prosperity and stability, and its status as an IFC will continue to be strengthened.
I think the important point for all of us is really just to address the risk, manage the risk. But at the same time, we are seeing loads of different opportunities. You talk about how our capital markets are really getting very vibrant. But it's not just the equities market. It's also the bond markets. If you look at the issuance of dim sum bond, one-time bond, green bonds, it's broken all the records. So I thought the market sentiment here is really vibrant.
Really excites me about this part of the world is the growth in wealth, right? So it's at least 2% higher than any other part of the world. We've got a 47% explosion in Chinese ultra-high net worth individuals, forecast to 28. So, I think even as we look at what's quite a difficult and choppy set of markets globally, we're really positive about Asia.
There's more appetite for it than there was 12 months ago. I remember actually last November sitting in a dinner in the United States with a group of U.S. investors. And this topic came up, and there were a couple of investors that basically said, we all should be looking to China. And the reason that had evolved that way is if you look last fall, the prices had gotten so cheap, the capital flows had moved so in the other direction that you just knew that things would come more into balance and there'd be a recycling. And we've seen that recycling.
What a day, what a week when it comes to Hong Kong. And certainly you heard from some of our big guests here this morning and really talking about the vibrancy of this market, how bright the prospects are. We heard that from the Vice Premier Lifeng in his opening speech here at HKMA. And certainly it seems like those good vibes can continue here today.
Yeah, I mean, it's the stars have really aligned for this one. And to your point, right, what a week it's been. It's only Tuesday. It almost feels like we're pushing towards the weekend with the amount of activity that's already taken place here. This morning, we've had a ton of interviews just now. And of course, there's lots more coming up here on the show. And Yvonne, we're just talking as well on, this is the 4th edition of the HKMA Financial Leaders Summit, which was supposed to be, as Eddie, your host, who joined us on shows earlier on, said, it was supposed to be a one-off thing.
It was only supposed to be an exit of COVID sort of way of telling people that they're open for business. Back. And then they felt the need to do this every single year. And this is, I think, the second time that both of us have been here live on set and really kind of talking about, it seems like the feeling on the ground has changed, that this resurgence that we're seeing in capital markets here in Hong Kong certainly is real. You heard from David Solomon, Goldman Sachs leader, saying, really there's going to be a lot of deals, and he's very constructive around this part of the world for 2026 into 2027 too, Dave.
Well, I mean, speaking of deals.
Yeah, we got a big one to tell you about.
Yes, in fact, why don't we get that started right now? So you have State Street and Mizuho completing a deal last month for State Street to acquire Mizuho's overseas custodian and related businesses. Now, it includes State Street taking on, as you can see on your screens here, Mizuho's offshore securities services and also some lending services in the United States. For the rationale behind the deal, why they did it, what the plans are, no better people really to tell us those things than joining us here on set is Ronald, Chairman and CEO of State Street, and of course, Masahiro Kihara, President and Group CEO of Mizuho Financial Group. Thank you so much for taking the time. I think this is the first for us, really having two global CEOs, so we appreciate the time. Very, very basic question. Why did you guys do it? Masa, let me start with you.
Yes, thank you very much for having us. The global custody business is a very capital-intensive business. You need scale, and the market is dominant by a handful of players, and we don't have the scale. So it was very logical for us to think about selling this business. And we had a great relationship with State for many years. Ron and I had cultivated a great relationship for 2 years or so. And State is very good at this business, and they have extensive knowledge in this. So it was very logical for us to start talking with Ron about selling our business, and it made it through. Moving forward, I think we have two responsibilities. We want to transfer our clients to State, make sure that happens, and we will transfer our people to State for a certain period of time. Also, we want to make sure that our clients will get the demand, their demand from State. And for such purpose, we will also transfer people to them. Yeah.
Okay. Ron, from your vantage, what does State Street get out of this deal?
Well, we get a couple things. As Kihara-san mentioned, this is very much a scale business. So when we have opportunities to acquire high-quality scale, like we saw in Mizuho, that's something that we're always interested in. But secondly is we're very optimistic and have been for several years now in Japan. We've got a presence there, and this was an ability, though the clients are the global custody clients, and Mizuho will remain as our local sub-custodian. It is a set of Japanese clients that we will now be serving. And if our belief is as we serve them well, reputationally that'll help us in Japan. So it was really a twofer for us, this idea of more scale in places like Luxembourg and the U.S., and then this tremendous client base, and then finally just a great partner, an ongoing partner with Mizuho.
Right. I think the deal was announced back early this year, and of course it recently just completed. At a time of transition, there might be some concerns among clients, of course, what happens to my account, how I do this. From their perspective, is there any message you want to send clients, your clients that then become your clients? How does that transition work? Masa, let me start with you.
So far, we have been talking to our clients already.
Right.
And I think they are very confident that state will deliver the demands of our clients. But having said that, we want to make sure that that will happen, and we will have our people transferred to State Street so that our clients' needs will be listened by state. And I think Ron will do that. And I have full confidence in that. Yeah.
Yeah, part of the appeal of the transaction was that the Mizuho staff were coming to join us.
Yeah.
They're very high capability.
And you're keeping that staff.
We are keeping that staff. And in the custodial world, which is very bespoke, very technical, but Japanese clients are known as being the most demanding service-wise. So we try and build our entire service culture, and we've done this for years, around what do Japanese clients want and need. So the ability to bring in more staff of that quality is very important to us.
And Ron, you mentioned that, this doesn't seem like a one-off to you, that Japan is one of your fastest growing businesses and markets out there here right now. In terms of just the amount of flows that you're seeing, how much are you still seeing going into Japan right now?
Yeah, so there's been, it seems like a long time where global investors have been waiting for this. And in fact, for a long time, you started to hear things like, well, is Japan even relevant any longer? But if you think about the economy, think about the manufacturing base, and now think about what's happening there from a government policy perspective, a real desire to move more capital into markets, to deploy more capital, transform the savings society into an investment society. So all those things have lined up in a way that we see a further growth spurt in Japan that we think will be sustained for quite some time.
I mean, we cover markets every day, and if you told us just maybe this time last year that the Nikkei 225 would be at 50,000, I would definitely call you crazy and even pay for the ambulance to pick you up. But here we are.
Yes.
How is that playing out? Give us the domestic story. Like, how alive have things become?
Thank you very much. I never expected that last year either. So, but I think one thing is that we have a new prime minister. She said she has a very good vision, I think, to make to get the Japan better. Get growth, and I think she is a very visionary actually. So I think that is very playing well in the market right now. I think that's the part.
What are you excited to see the most out of this new government then?
Yeah. She has raised several items that has to be solved. I think today she announced that she will co-invest in 17 areas. That is very important for Japan from a growth perspective.
Right.
So that kind of thing. She will also try to reform the social securities for the young people. I think, and these two are very important for Japan.
In fact, I just want to pick up one of those points because for the longest time there also wasn't an interest rate in Japan. It was zero at best, and now you have an interest rate. In fact, the debate right now is interest rates might be too low. In Japan. What is your outlook for interest rates in Japan?
Well, it's right now the policy rate is 50 basis points, as you know. I think there is a room for another hike or two hike or so, given the inflationary thing that is happening right now. I guess the BOJ is waiting to see that there will be a wage hike again next year.
Right.
And if they get confident about that, if they get confident about that, they will definitely be able to raise rates. Yeah.
And Ron, you talked about all the money and flows coming into Japan. Is there something to look at in terms of Japanese investors and putting their money outside the country and divesting maybe out of their home country? Is there a trend that you think that is emerging now too?
I think that's likely to occur. I mean, if you look over the past 2 or 3 decades in Japan, Japanese investors have invested, but they've often invested in products or been offered products that have been very short-term in nature. The fee structures weren't the greatest, and in terms of beneficial to them. And what you're seeing now is a comprehensive set of policies that are meant to instill confidence in savers to actually deploy capital as investors. The regulatory structure is really focused on appropriate pricing structures, making sure that mis-selling doesn't occur. So there's just a nice alignment of policy here. And so we would foresee that there'll be more investing initially in Japan.
Right.
I mean, not least of which is what we've seen over the last year in terms of market performance.
For sure.
But also more broadly in Japan and outside of Japan.
I wanted to ask you about that. You know, what part of the deal, I guess the deal was also given the backdrop of, in a couple of years, do you expect more flows from Japan into other markets? And is this deal specifically a way for you guys to capitalize specifically at State Street if we do get those outflows coming out of Japan into other parts of the global equity markets?
Yeah, and that's how we'll be positioned, right? Because now that we're the global custodian, right, for these assets, certainly any of those assets that flow out would be beneficial to us. And so we will be well positioned for that.
Right.
Masahiro, you mentioned about this deal, you can focus on the domestic business more closely now. What's going to be the strategy moving forward?
Well, so we focus on 4 areas, actually. Japanese retail, asset and wealth management, and then Japanese corporates, Japanese CIB, and the global CIB. So we will be able to reallocate our resources into our 4 areas. And,
What's the sense you get from your clients, corporate Japan and retail investors? Is the economic picture the way we see it in headlines? Is that what's happening on the ground?
I would say that, the retail is moving into investment, actually. That has happened maybe started from a year ago.
Right.
I guess this will be enhanced given all these talks from the new prime minister, number one. I would say that Japanese corporates will start investing in Japan to the areas that the prime minister talked about, the 70 areas, I think.
Yeah.
So I guess the dynamics will change a lot in Japan in terms of that. And then we can also get foreign investors coming into Japan to invest in Japan too. Yeah.
In terms of you're forecasting maybe 2 hikes for Japan coming forward. What does that mean for the bank? I mean, in terms of ROE, are we expecting a significant lift from that?
So
that's a good thing for you.
That's a good thing for us. I won't say it loudly in the public.
Like it's a bad thing,
but 25 basis point increase will give us somewhere around 100 billion yen increase in our profits. So definitely, currently our ROE is somewhere around 10%. It will probably go around 11, 12%.
I mean, for the longest time, there was always this fear and concern that you could not raise prices in Japan because the yen demand wasn't there. Do you think that mindset's completely gone now? People are used to high prices going up, and you're confident that you can do the same.
So, as far as I see in the retail sector, the companies that are passing on the cost to the retail, actually. And that's happening, actually. Although not fully, but let's say somewhere around 50 to 60% is passed.
Right. Ron, outside of Japan, what do you see the most areas in terms of geographies where you can make the most impact now?
So I think what's going on, people talk about deglobalization, and I think it's really a reglobalization. And sure, there's some pullback to to national countries, if you will, and a lot of that is supply chain driven and securing supply chain. But the idea that everybody's going to do everything for themselves is simply not true. So what you're seeing is old trade alliances are breaking down and new trade alliances are developing. And the place where that's front and center is here in Asia. As the China direct to U.S. trade becomes less important, it's not going to go away, but it'll still make it there, maybe through intermediary countries, investment out of China into other countries that then gets into the U.S. I mean, ultimately, the goal for the foreseeable future is to provide goods to the U.S. consumer. It's the largest economy in the world, 75% consumer driven. And so this idea of reglobalization is actually an important one because you'll see new businesses developing. I mean, today, the largest port, the largest country landing in the port of Los Angeles is Vietnam. 2 years ago, and for the prior 20, that would have been China.
Right.
And it's not that China isn't landing in LA, but Vietnam's gotten larger. So that's an example of some of this reglobalization that's going on. Similarly, and you've heard it today at the conference, capital flow is reglobalizing too. And where and how capital flows. We're here in Hong Kong for a very important reason because it's a node that really connects China with not just the U.S., but China with the rest of the world. And I think of it almost as you know, think about it as railroads. You've got this now great switching yard called Hong Kong, both for goods and, as importantly, maybe more importantly, for capital.
Yeah, I was about to say, you know, this reglobalization concept, right? The HKMA hosts an event like this, and everyone from the world is here. We were just talking to some people. Everyone knows each other inside this room. I want to get a sense of I think there's no better person to ask but you in terms of the flows you're seeing as a global custodian bank. People talk about we're re-engaging our exposure to the Chinese markets. We're re-looking at China. What are you seeing exactly as far as, are people backing up that claim?
So maybe at a high macro level, over the past several years, the flows have been, capital flows have been to the U.S. And if you're invested in the U.S., you really couldn't go wrong. That started to change, and there was a massive overweight position to the U.S., both equity and debt. And that started to change about this time last year. You started to see the overweight position coming down. It accelerated at the beginning of the year and reached its probably its bottom in April, around Liberation Day. And everybody at that time thought, okay, this really is, we're going to see massive flows now out of the U.S. Well, you haven't seen that. And a part of it has been for, I think, the fact that the tariffs are proving not to be as bad as we thought. And there's almost a pattern that's emerging now and here in terms of predictability. And remember, markets hate uncertainty, right? You'd rather know that something is bad for certain than wonder if it's going to be bad and be uncertain about it. And then secondly, U.S. companies have proven to be so profitable and enduring.
Is it less uncertain now after what happened last week in Korea?
Much less uncertain. Much less uncertain. And I think that's good for the world. Now, having said that, I'm a big believer in this reglobalization concept. So will investors be rewarded by going to places other than the U.S., or I should say in addition to the U.S.? I absolutely believe that. I mean, I think that certainly in Asia and parts of Europe, and the valuation gaps still remain high, so good companies are cheaper.
Ron? Masahiro, we got to leave it there, but thank you so much for joining us here. Ronald Hanley there, Chairman and CEO of State Street, and Masahiro Kihara, President and Group CEO of Mizuho Financial Group. All right, we got lots to come here at the HKMA event. Still ahead, we speak exclusively to Franklin Templeton CEO Jenny Johnson about the company's investment strategy in the region in China. You're watching The China Show live from the HKMA Global Financial Leaders Investment Summit. This is Bloomberg.
Right, welcome back. You're watching The China Show. We're about 51 minutes or so into the cash market session, and Min Min Lo is watching markets for us today. Min Min, what's going on?
Yes, David, it looks like Asian markets are seeing a little bit of a pullback at the moment. You can see the Nikkei is trading slightly flat as we return from the holidays, still close to record highs at the moment though, but the Kospi really leading declines here, down 1.6%. Perhaps there's a bit of a profit taking going on after the record highs that we saw yesterday, and this is despite the huge rally we saw overnight with the Mag 7, right? There was a big $38 billion deal signed between OpenAI and Amazon to get access to hundreds of thousands of these NVIDIA GPUs, but it looks like markets are shrugging that off at the moment. And perhaps it is the Fed story in the U.S., the murky outlook around the December rate cut outlook that is weighing on sentiment at the moment. The Hang Seng also not doing a whole lot here. But we take a look at some of the movers that we're watching today. We are keeping an eye on some of these EV players because BYD, Goldman Sachs just raised the price target for this company by about 8% or so to about 140 Hong Kong dollars on the back of strong expectations of its overseas push. But still, you're seeing markets largely on the downside here for the EV players, down 0.8% for BYD. Perhaps still a lot of that disappointment from BYD's third quarter earnings as well. And we're also keeping an eye on some of these travel stocks as well. China just announced that it is extending the visa-free policy for 45 countries until the end of next year. But here we can see pretty mixed right now. Trip.com and H World looking positive here, but Tongcheng Travel down about 0.8%. And this is, of course, part of the government's plan to boost inbound travelers' spending as a means to boost domestic consumption as well.
Min Min, thank you. Min Min Lo there joining us there on what's going on in markets here. Yeah, we're going to take you back to inside the conference room and really what's been going on. This big panel among some of the Wall Street banks here at the Global Financial Leaders Investment Summit. So there you go, Ted Pick from Morgan Stanley. And of course, we have Goldman Sachs' David Solomon as well. Why don't you know Ted Pick is going to be joining us in the next hour or so here on Bloomberg TV. Plenty more ahead. This is Bloomberg. All right, we haven't caught a break. We haven't missed a beat, really, when it comes to the Global Financial Leaders Investment Summit here. A panel on market trends is ongoing there. You're hearing from Ted Pick, the chairman and CEO at Morgan Stanley. He's joined by David Solomon, the chairman and CEO of Goldman Sachs, and Mike Gitlin, the president and CEO of Capital Group as well. Certainly coming at a time when, you know, we heard from David Solomon himself talking about he's expecting a flurry of deals really to happen for the next 2 years coming from either Hong Kong or this part of the world here. He mentioned about capital markets are strong. Goldman Sachs certainly is well positioned in that too.
Yes, the window is open for CEOs to pull the trigger on deals. He's also talking about just commentary coming through as far as the equity market goes. He does see the possibility, David Solomon, of a drawdown in U.S. equities. And just to mention, David Solomon joined us and showed us earlier on. And in about an hour's time, Ted Pick out of Morgan Stanley will be joining us here on sets. Stay tuned for that and plenty more. This is The China Show.
I'll start with David again. Goldman Sachs has been very active in China, and I just learned that you're flying up to Beijing after this this morning's session. So since this deep-seek moment, people are taking a different view on China, and given what's happened last week with the, what do you call, truce or trade pact between U.S. and China, how are sentiments changing, and what would you like, and what would you see in the next few years?
I'll make a couple of comments around that. I mean, you know, sentiment with respect to Chinese equities certainly had a lot of room to change. If you go back to a year ago, you know, after what happened in 2020 and 2021 and 2022, kind of six trillion was wiped out. And so you've seen year over year since we were last year about an 80% move in Chinese equities, and that kind of makes up about half of what was lost during that, you know, during that period. And I think it's reflective of whether it's the deep-seek moment or just a more normalized kind of long-term view and also just the fact that on a global basis, with valuations moving up, a lot of these Chinese equities look very, very attractive. China is one of the largest, most important economies in the world. Global capital allocators will continue to be interested in China in almost any environment. I think what you've seen over the course of the last year is a little bit, after a shift away, a little bit of a shift back from global capital allocators. And, my guess is that'll continue with this a little bit greater stability over the course of the next year versus what we've seen over the last 12 months.
I moved to Ted for the rest of Asia. You've seen actually the regional markets are actually growing very rapidly as well. That includes India, Japan, and Southeast Asia. So the MSCI Asia Pacific Index are up 20% this year. So we remain positive. Morgan Stanley remain positive on Asia in this region. So which are the markets which really excites you, and which are the markets which are more developed markets or more EM markets?
Well, I would echo David's comments. Hong Kong, China is where it begins and ends. The developments, if you believe in a market where investors will reward great companies and where dispersion matters, AI, robotics, EV, biotech, you have not just national champions, but global winners that are listing in Hong Kong, raising capital, and effectively establishing themselves as world's top 2, 3, 4, 500 companies immediately. So really, you start here. But as you look to in Japan, and you start thinking about not just diversification across asset classes, but diversification across geographies, it's hard not to be excited about Hong Kong, China, Japan, and India, 3 vastly different narratives, but all part of a global Asia story. In Japan, you see the reawakening of investor interest and corporate governance, and there is a ton of corporate activity that is underway and will continue. And then you have in Japan the reality of demography and the very slow but inexorable move of yen plus real estate is a savings portfolio into something that looks like a traditional invested portfolio, and that's something we're very excited about. And then India has enormous infrastructure-led runway, will be one of the world's most deeply held markets once we see the kind of deregulation that we would expect over the next 5, 10, 15 years. So if you think about the next 5 years, and we talk about the need to diversify as between risk and non-risk assets and between public and private assets, it really does matter now to have that geographic footprint in all 3 major locations. Very different narratives, but all should generate alpha and positive risk-adjusted returns over the next 3, 5, 10, 20 years.
So Mike, a year ago, or even before then, we're talking about the growing power of passives, and passives ETFs been like dominating. New money is going into passive. But now it seems that it's moving to active and active ETFs again. Maybe you explain a little bit about that trend change and where would it lead to, and how should Asian investors benefit from it?
Yeah, I think what's starting in the U.S. is expanding globally. If you look at ETFs, it's an investment vehicle. For 30 years, we let the vehicle be described as passive because there weren't active alternatives. Now that there are active alternatives, the adoption rate is much faster than any of us would have imagined. I'll just give you a sense for us. We launched active ETFs in the U.S. 3 years ago. We reached $100 billion of assets this week. And the flow rate is about $1 billion per week. So the interest in getting those active outperformance.
Good morning, and welcome back to the China Show. You're just looking at some live pictures there inside where we are, just outside this location, of course, at the Rosewood Hotel, the Global Financial Leaders Investment Summit. This panel, of course, on market trends ongoing there. So you basically saw everyone there on stage. And I think one of the last points I caught there out of, I think it was David Solomon who mentioned that don't be surprised. It's possible we do get, when people think the market just keeps going up, 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 and up, this can go down every now and then.
There could be a 10 to 20% pullback, he says, when it comes to U.S. equity markets, right? That drawdown could, we've been waiting, anticipating on what could be that trigger, but certainly that is something that he is watching out for as well. Joining us exclusively is Jenny Johnson, the CEO of Franklin Templeton, who's also here as well. You were in that room and you were hearing those men talk about maybe what the risks are there to these bull markets that we're seeing across global equities here right now. What sort of risks are you seeing on the radar now, Jenny?
So, I agree with David's comment. Well, first of all, we all know markets are not linear. They don't just go up. They go up and down as whatever the trend is. I think, though, one of the concerning trends that would support kind of David's concern around whether there's a little bit of a correction is just that there's been this concentration of retail money straight into the market. So most institutions seem to be sort of staying the path. And the retail money, I just read something that said 1 in 4 ETFs that have been issued in the last 12 months are levered ETFs. And that the retail money is tending to go and concentrate on things like AI, quantum computing, thematics. So that then means that you end up with, things being overpriced potentially. Right. I always say you have to separate the market from the economy. I'm very bullish on the economy. I think there's a lot of good, positive things going on there. But the market's been a bit one-sided. It's all been about these large cap growth. It's mostly been sort of 6 stocks. But when you have now adding this kind of levered ETFs that are focused on that concentration, that's where I think you're going to get volatility and you could have a correction.
It's a good point you made. One of the comments I keep getting on the show is, these are good companies, but they could be bad stocks on a stock of its own. But you hear someone like Jensen Huang, for example, who said just last week, there is no bubble. And you look at these companies doing literally, in some cases, trillion-dollar deals, and you get a sense, is there really a bubble, or is there really something that they're prepared, because they're putting their money behind this endeavor. Yeah. How do we square that with like a $5 trillion company like NVIDIA, for example?
Well, look, I think NVIDIA is an amazing company, and it's got tremendous opportunity, and I think we are at the early stages on AI, so no question on that. But again, you have to separate valuations, right. And anytime you start getting this concept of sector-specific thematic levered ETFs, I just worry a little bit about kind of the short-term volatility. Right. But what happens is the retail investor says, wait a second, NVIDIA is only down 10%. Why is my ETF down 20 or 30%? Somebody told me that, I don't know if this is true, but there was like a 5 times levered ETF. That's a very different experience for the retail investor, and I'm not sure they always understand that.
And I think up until last week, right, this was a market that was supported by the Fed expected to resume this rate cutting cycle. And it seems like what we heard from Jay Powell last week was that December is not a guarantee. How are you looking at that? And is that going to be a sort of headwind for risk assets?
I think it's quite possible the Fed doesn't move in December. There was actually a really good study done by the Dallas Fed, because everybody points to the lack of job creation in the U.S. and saying, well, if there's not job creation, it must be a slowed down economy. But the Dallas Fed said, hey, pre-COVID, you needed 100,000 jobs a month to be kind of at equilibrium with unemployment. Now says you only need 30,000 jobs in a month to have equivalent, because their labor participation is down, immigration is down, and obviously an aging population, which means, well, wait a second, how can companies grow and not create jobs? Yeah. And you see that productivity is up 1%. So there's about 156 million people in the U.S. That's about 1.5 million people. So you actually, it kind of explains it. And then if you just look around, earnings growth, companies' earnings growth are increasing. Honestly, the fixed income markets are kind of priced for perfection, not really for any kind of problems along there. So I actually think the economy's strong, and I think there's a real argument for the Fed to just sit, let the last cut continue to be digested, and see how things go.
I think before we talk about China, and I think you have another deal too, can I just ask you then, it seems we're going into a good 2026. I can't think of a major risk to think about. Last year was the elections. What policy settings were going to be monetary, geopolitical. There doesn't seem to be anything I can find. And I'm in the media. I'm used to looking for bad news.
I was going to say, those are such famous last words that you always worry about.
But what's the risk? What's the risk that you think we should be at least wary of?
I mean, honestly, in 2026, you have things like, actually, the big, beautiful bill had front-loaded a lot of the tax benefits. I think that was probably to set the economy up pretty well for midterm elections. There's going to be a massive amount of tax refunds that come in the early 2026. 2026. I think the rest of the market, other than the 6 stocks that we're kind of focused on, is actually not trading that expensively.
Okay.
And it feels like we're working through that. Things were positive with Trump and Xi, and as you have less volatility on tariffs, that also gives confidence in the market. Yeah. So I'm kind of with you. It feels like, and AI, again, I think we're just starting to see the benefits of AI and how they impact individual companies. So far, the beneficiaries in the market have all been the picks and shovels. It hasn't even been digested into people's business models and therefore operating income.
Fair.
Does that give more credence to what we're seeing in China as well? This AI boom that seems to be helping this whole equity market go into bull markets here right now. This kind of slow burn that we're seeing, or slow bull market, as you're saying, in China, does it look sustainable in your eyes?
I mean, I think China's got a lot of their own plans on AI. We saw it with the DeepSeek moment, where obviously there's a lot of focus there. China's got tremendous expertise in EV batteries. Many people say they're leading in it. Robotics, AI. So I think we're all bullish for China. Plus, I think that the policy has tried to get the consumer to spend more, to be more focused on stimulating the economy in China. So, and honestly, China's pretty cheap compared to other parts of the world.
I was going to get one more take on the whole Sell America theme, right? That was probably prominent maybe about 6 months ago. But I look at a U.S. 10-year yield that's sub 4% now. I look at the equity markets that are still at record highs in the U.S. Is it more on the margins then, to sort of kind of diversify out the U.S.?
Yeah. Look, I think America, the U.S. has amazing innovation, and it continues to lead in innovation. So that's the positive. The challenge has been the currency, right? If you're not a U.S. dollar-based investor, you had this massive headwind with the dollar depreciating, and there's some that think that there may be still more in that. So that's a natural headwind that happens to a non-U.S. investor.
Yeah. You have a big announcement you want to tell us as well. Tell us a bit more about this tokenized money market fund that you're launching.
So actually, all the way back in 2021, we launched a U.S. money market that is natively based on the digital blockchain. Many of the other, actually, I think all of the other tokenized money market funds are what are called digital twins. They shadow on blockchain.
Okay.
Because ours is natively on the blockchain, and our big announcement is our G-Benji is being launched in Hong Kong. So it's a usage version that has been approved here for institutional investors. We're hoping to bring it to retail investors. When it's natively on blockchain, it allows you to do things like we pay the yield every day in the account. If you own it for a partial day, 4 hours, 32 minutes, and 22 seconds, you will get paid yield on that. You can do peer-to-peer transfers. So it's simply that this technology of blockchain enables a lot more features, and so we're really excited to bring this here.
And the type of investor that would be suited for this, is it an income product? What is it?
Yeah, so it's a money market fund, right? So it tends to be short duration. It's yielding, I think it's just about 4%. So it's an income type product. You can have higher yielding, riskier income products. This is
higher yielding stable coins, some say.
So stable coins don't provide yield, right? They're stable coins. So this is because the yield tends to go to the owner of the stable coin. In the case of money market fund, we take a small management fee and pass the yield on to the investor. So, we're building things where you can have, again, because it's natively on blockchain, you can trade it 7 days a week, 365 days a year. And so we're working through where you can on a Saturday say, I've yielded up, now I need to make a payment. I'm going to convert it into my stable coin and make a payment with that stable coin.
G-Benji.
G-Benji.
G-Benji. Thank you so much. Jenny Johnson, fantastic having you. Thank you, as always, for carving out some of your time for us here.
Thank you.
Jenny Johnson, guys, CEO of Franklin Templeton. Plenty more ahead. This is The China Show.
I think it looks like we're into a break right now, so it's getting loud outside here at the Rosewood Hotel. But we did earlier speak with the Goldman Sachs CEO, David Solomon, saying that this one-year trade truce between the U.S. and China delegation is really enough time for the two sides to reach a constructive trade deal. We spoke exclusively to Solomon here at the HKMA Global Financial Leaders Investment Summit.
Well, it seems like the meeting was constructive. I'm watching the news the same way you're all watching the news. I think at the moment, a de-escalation is a good thing, but there's obviously a lot of work to do to really arrive at a real stable deal that can endure, over a period of time. I'm encouraged by the prospect of a potential visit from the U.S. president that was telegraphed in the fall, but for the moment, I did not think the escalation on either side was constructive, and so, I much prefer a de-escalation. And I think both sides really had a purpose in that meeting to talk constructively, to have a more de-escalated environment, and that allows now for constructive conversations as they move forward.
1 year truce, though, is there pros and cons to that? What does that do to business?
Sorry, I couldn't hear you.
1 year truce, though, between the two. Is that a good or bad thing? I mean, what does it do in terms of business sentiment when there's a 12-month time frame now we're talking about?
It's better than an escalation at unreasonable levels, which is kind of where we were, over the most recent time. Trade negotiations are complicated, and there are a lot of issues on the table. They need thoughtful responses and responses that can be durable, that both sides embrace and get to the right place. Yes, there's some uncertainty because it's a 1 year, it's a 1 year delay in all of this, but it's also a realistic period of time to try to get the right kind of deal done so both economies can move forward in a constructive way. And look, these are the two most important economies in the world. I think it's very important that, we arrive in a better place where we can both participate constructively with each other in the global growth of the world.
I mean, speaking of, let me borrow your phrase, participate, there's been a resurgence in equity capital market raising here in Hong Kong. A lot of the Chinese companies, tech or otherwise, are raising capital for the future. I want to get your sense, as someone who sits in New York, you travel, of course, all around the world. Is there a lot of appetite now from U.S.-based investors to participate by giving that capital to Chinese companies right now in order to realize their ambitions?
Sure, there's more appetite for it than there was 12 months ago. I remember actually last November sitting in a dinner in the United States with a group of U.S. investors, and this topic came up, and there were a couple of investors that basically said we all should be looking to China, and the reason that had evolved that way is if you look last fall, the prices had gotten so cheap, the capital flows had moved so in the other direction that you just knew that things would come more into balance and there'd be a recycling. And we've seen that recycling. You've seen a big move in prices year over year. You've seen more foreign capital come in and start to participate. That's a fundamentally different question about the big capital allocators really fundamentally shifting their allocations up to be higher again. So foreign direct investment in China has come down. And I think one of the big questions is until we understand kind of the trade and the geopolitical landscape, it's harder to see significant shifts back to higher levels of foreign direct investment and more capital allocation. But for the moment, those flows are making for a better IPO market here and more opportunities here.
We've seen governments being, I guess, more involved in some of these business deals. I take a look at Intel, for example. I look at Nippon Steel, even CK Hutch, which Goldman Sachs was a sole advisor to. What's the advice now to clients now in terms of that intervention risk?
Well, you just mentioned three different deals, and they're completely different.
Right.
I mean, they're completely different. Governments are always going to opine and weigh in on different transactions. There are regulatory approvals in the United States. There's CFIUS. There are all sorts of issues where governments weigh in. That is a very different thing than a government taking an investment, in a specific company. Wouldn't surprise you, I'm not a big fan of that as a general practice. That doesn't mean there aren't exceptions, because I believe that the markets should allow capital formation and competition, around companies. And, this administration is in one or two situations. They're taking actions like that. As I said, I'm not black and white and dogmatic. There can be exceptional circumstances, but I don't think as a general practice, having governments take stakes in companies is the direction of travel we want our free market system to go.
Goldman Sachs CEO David Solomon there speaking to us a little bit earlier on. Of course, if you are a subscriber and can turn to your terminal for more on what's going on at the HKMA event, Live Go is your function for the latest updates. We got plenty more ahead. This is Bloomberg. All right, we've been live here all morning at the HKMA Global Financial Leaders Investment Summit, and really, it seems like there's been, everyone's talking about how bright the prospects are here in the city. And we were just talking really about whether the China business and what people are looking at here, the deals that they want to talk about, but also talking about the risk, right? You've been kind of jokingly saying that you don't see anything on the radar there.
I really don't.
What could really kind of derail these markets. But what we heard just now inside was a David Solomon from Goldman saying, look, expect the possibility of a 10 to 20% downside in equity markets for the next 12 to 24 months.
The fact that he even has to say that global equity markets go up and down. 10 to 20. That should be normal.
That should be normal.
And the fact that that is one of the visible risks out there just speaks to how really good the stars have aligned, right? At equity markets, we have a trade deal. The worst case on the Fed, based on the information we have now, is maybe they'll hold, but they're still going to cut. So it seems that we are going into 2026, and with the bull market, frothy valuations in some parts, but it does seem like things are shaping up well. The other thing that stood out to me as well, interesting insights on the BOJ out of Mizuho, that in a world where things are cutting, they do expect the BOJ to hike rates even further, 1 to 2. And I think that's going to be very good for the Japanese side of things.
11 to 12% in terms of ROE when it comes to Mizuho itself, and really how they're positioning themselves is that I think that this new government is going to bring a lot of change, and it's for the positive for markets here. And he says even when it came to 50,000 on the Nikkei, he was also laughing when you brought up that sort of milestone too.
Yet we're here, and it makes sense. It's the point. Right, so just before we wrap up this bit, of course, there's plenty more ahead here from the HKMA Summit, just to tell you about some big interviews coming up here still from the ground. Of course, lots to talk about. We heard from, of course, David Solomon just now. And in a couple of minutes, there we go, Ted Pick, Morgan Stanley, Chairman and CEO, will be joining us here in sets at those times on your screens. Plenty more ahead. This is Bloomberg.